In this video, we'll discuss our update on the economy. Economic developments still remain tied to COVID. Omicron caused a large spike in cases given its transmissibility, but has proven to be far less severe than prior variants. This is highlighted in the decoupling between cases and deaths, with total fatality rates declining. It's also in line with recent medical evidence indicating variants may become milder and milder over time. And this has led to some optimism that a silver lining of Omicron's spread and relatively mild symptoms is that we may achieve herd immunity sooner, and in turn bring forward a return to normality. Recent data shows the US may be past the peak. We should expect continued improvement in cases, particularly if we follow the same trend as the UK and South Africa. There is also a clear hesitancy by policymakers to impose new restrictions. And maybe more importantly, the economy has largely adapted to the new realities of a COVID world. Businesses across all sectors of the economy were forced to invest heavily in technology to stay competitive, while consumers have adapted their spending habits. Because of these factors, we anticipate any future spikes in cases will have less of an economic impact over time. We already had a trend toward online spending before COVID, and that has only accelerated. Consumers' habits have changed, but spending remains strong. Data continues to show strong retail sales despite the effects of Omicron. This is really important, as consumer spending makes up about 70% of GDP. And that spending is supported by an incredibly healthy consumer. As these charts depict, consumer balance sheets are very strong. Household net worth is at all-time highs, while household debt servicing ratios are near all-time lows. The economy is also supported by a very strong labour market, with the unemployment rate dropping precipitously following the COVID peak. And we're seeing an incredible bounce back in prime age employment relative to prior recessions. I'll speak to Fed policy shortly, but as you can imagine, given the strength of the labour market, the Fed is currently far less concerned about their full employment mandate and much more concerned about maintaining inflation around the 2% level. So what does all this mean for growth? We expect above-trend economic growth over the near term. 2021 full-year GDP growth came in at 5.7%. In 2022, consensus estimates are for growth at just under 4%. Those estimates have come down recently due to the effects of Omicron. We expect the economy to transition back towards long-term trend growth over time, with consensus estimates of 2.5% growth in 2023, though that is still above the long-term trend growth rate of 2%. We also anticipate the fiscal tailwind to moderate moving forward. For context, in the 18 months post the COVID-driven sell-off in March 2020, about $5.3 trillion of stimulus was injected directly into the economy. Moving forward, the recently passed infrastructure package is about $1.2 trillion, and negotiations are still ongoing regarding the Build Back Better package. Who knows if something gets done, but it's likely to be a smaller package. Regardless, this stimulus will be spent over years. Much of the infrastructure package, for instance, is set to be spent over the course of 5 years. One of the common questions that often comes up is about the level of federal debt outstanding. As this chart shows, it's set to be around 100% of GDP for the foreseeable future. However, we don't think the absolute level of debt outstanding is the most important metric. Rather, it's the ability of the government to service that debt that really matters. And the US is in a relatively strong position to service its debt due to low interest rate. However, we don't think the absolute level of debt outstanding is the most important metric. Rather, it's the ability of the government to service that debt that really matters. And the US is in a relatively strong position to service its debt due to low interest rates and above-trend economic growth. In fact, we don't think the level of debt outstanding presents a material risk, even with rising interest rates. Turning to inflation, headline CPI recently posted the strongest increase since the 1980s, as strong demand on the back of accommodative policies, coupled with supply chain constraints, led to upward pricing pressure. We believe inflation may migrate lower in the second half of 2022 as manufacturing bottlenecks eventually ease and virus improvements reduce production disruptions. Interestingly, if we normalise for the weak base effects of COVID in 2020 and go back 24 months to a pre-COVID timeframe, core CPI is running at an annualised rate of 3.5%. So yes, elevated, but not the level the headline numbers would suggest. In terms of the supply chain, there has been some improvement in delivery times recently. While Omicron has caused a shortage of workers and may have added pressure to the supply chain, it appears we are now past the peak, which may help improve supply chain issues moving forward. As such, we expect supply chain issues to contribute less to overall inflation, particularly in the back half of 2022. Thinking longer term, while the red bars in this chart depict that short-term output gaps remain tight due to ongoing supply chain issues, the blue bars indicate that all countries have a significant amount of long-term productivity slack. This may help alleviate inflationary pressures as supply chain disruptions begin to abate. A backdrop of elevated inflation, above-trend economic growth, and a strong labour market forced the Fed into a more hawkish stance. The median estimate from the most recent dot plot economic projections in December was for 3 rate increases in 2022, followed by another 3 in 2023. However, January's meeting statement indicated 4 rate hikes are very likely this year. As such, we believe the Fed could hike as early as March, with consensus expectations for an increase of 1% or more this year. Clearly, there are upward risks for rates. I'm Kieran Osborne, and this video discussed our update on the economy. For more information, please visit missionwealth.com or contact your client advisor. Next, we'll take a look at our outlook for financial markets.